Welcome everyone. Started. Just want to thank everyone for joining us. Thank you BMNA members for joining us today also. If you lease your building, equipment, your operations, if you have a lease of any kind, you're in the right spot. I'm Carolyn Powell, Business Development Director here at Troncony, Seguran Associates, and I'll be your host today. There are multiple ways you can engage with us today. You'll see there's a toolbar at the right-hand side of your screen. If you have something that you want to casually say to us, you can put that in the chats. If you have a formal question for our experts, put that in the Q&A. We'll try to get those answered throughout the presentation, make this conversational. So if there's something along the way, just let us know and we'll get that answered for you. And also today, there's a couple different items in the handout section. We have a full list of the new Lease Standard. There's a one sheet in there. The presentation is in there if you want to download that. There's an additional one sheet and full bios of our experts today. So a couple different things you can utilize that chat for, and definitely the Q&A. If you're expecting to receive CPE today from today's session, you'll need to remain on the webinar for 50 minutes and answer 3 out of the 4 polling questions. After the presentation today, you'll receive a webinar survey. If you could please complete that for us. Let us know what you thought of the webinar and any feedback you have. We're always looking for that. If you'd like someone to follow up with you today, let us know. And again, if you're expecting CPE, please make sure you include that in the survey. The CPE will be sent out later today or tomorrow for you. So without further ado, let's get started. Troncony Seguran Associates is a certified public accounting and business consulting firm. Chuck Pizzino is a CPA and partner at the firm and has over 25 years of public accounting experience. He has substantial experience with technical accounting and financial reporting. Jeremy Belicha is a CPA and partner on our accounting and audit team. He has been in public accounting for over 13 years and has worked on many audit consulting projects for his clients. Again, their full bios are in the handouts that you can grab. I'm going to hand it over to Jeremy to get us started today.
All right, thanks, Carolyn. Thanks everyone for joining us. It'll be a quick 50 minutes of a very high-level summary of the Lease Standard. As we go through the standard, you'll see that most of the impact is on the lessee side. We will spend a few minutes talking about the impact from the lessor perspective, but significantly all the changes under the new standard are impactful for the lessee side. So in order for the CPE credits, we have to describe some of the learning objectives. And again, please do fill out the survey at the end. This is the first time that we're doing this specific lease webinar to third parties. So your feedback is extremely important. It helps us for future webinars focus in on areas that is important to each of the listeners. And again, thanks for joining everyone. So on the learning objectives, we're going to provide background and describe the scope of the lease standard. We'll talk a little bit about the importance of the new definition of the lease standard. It's a little bit different from the old definition. Chuck will discuss lease term, lease payments, and which will also help out with lease classification. So we'll spend a few minutes in that area. We'll discuss the main steps in applying the lease model. We'll explain the accounting under the lease standard. We'll have an example that we'll walk through some of the debits and credits. And we'll describe the presentation, disclosure, and transition provisions. Not only disclosure requirements, which are significantly expanded under the new lease standard, but also practical expedience and accounting policy elections that will help each of you adopt this standard. And then we'll wrap up. We'll discuss some of the potential implications of implementing the standard. At the end, you'll see a summary as well, which walks through a good synopsis of how to, at a high level, implement the standard. And then we'll answer any questions you have. So just a quick history and background. Now, this is many years in the making. The FASB started working on the lease standard project several years ago. I think it was 2013 or 2014 is when they really started undertaking this task. And it was a Herculean effort. the initial goals were a movement towards principle-based accounting standards and convergence with IFRS as well. But the major driver of the new lease standard is for transparency and comparability to rid companies of off-balance sheet financing, which is applicable for operating leases. One cool little fact is that the new lease standard is actually going to bring over $3 trillion of liabilities on the balance sheets for companies, private and publicly traded companies. As mentioned before, the effective date for the publicly traded companies has already been in place for periods beginning after December 15th of 2018. So calendar year, January of 2019 companies. We used a lot of the guidance from those publicly traded companies for our disclosures. Chuck will go through a publicly traded entity disclosure later on in the presentation. But for non-public companies and most not-for-profit organizations, the lease standard was deferred for many reasons. Complications that publicly traded companies were enduring implementing the standard and significant costs, as well as the impact of COVID. So as of 1/1 of 2022, the lease standard is now effective for all non-public companies. Early adoption is permitted, but at this point, obviously, we're here, so we'll just adopt it on a going forward basis. And as I mentioned before, this initial webinar will focus mostly on the lessee impact. So we'll spend a minute on the definition and the scope. So the definition of the new standard is a contract contains a lease if the contract conveys the right to control the use of identified property, plant, or equipment for a period of time in exchange for consideration. Now, the prior definition of the old standard just covered the right to obtain substantially all the economic benefit from the use of an asset. So the right to control portion of the definition was added, and that'll become important and will help determine whether or not you have a lease in some scenarios. And I'll give an example on the next slide. Most agreements, as we know, most lease agreements are going to be pretty straightforward, right? You'll be able to read through the agreement and determine whether or not a lease exists. But in certain scenarios, you may need to look back to the definition to really determine whether or not you really do have a lease. The new standard is applicable to all entities, both lessees and lessors, includes leases and subleases, and obviously for publicly and privately traded companies and not-for-profit organizations. We also listed a few exclusions of the lease standard. So essentially, the way I look at it is the lease standard generally covers all tangible property, equipment, and furniture and fixtures, as well as land. Okay. Step 1, identifying a lease. So determine whether a contract is or contains a lease at inception of the contract. That is the date that the contract is signed. It may not be the same as the commencement date, which is the date that the agreement actually takes place or is effective. One thing that I provide an example on is in certain scenarios, you may have embedded leases. You may have a service contract for an off-site hosting arrangement for a server. So when you're going through and implementing the lease standard, it's really important to take an inventory of all your agreements, not only what appear to be straight lease agreements, but also other service arrangements and contracts to determine if there is a lease of an identified asset. So at inception of an arrangement, the parties should determine whether the contract contains a lease by assessing both of the following. Is there an identified asset, which is explicitly or implicitly stated? If so, does the contract convey the right to control the use of and obtain substantially all the economic benefit of from the identified asset in exchange for consideration? So one quick scenario is if you have a long-term lease for a rental car, and the rental car is over, you're going to keep it for over a year, and the supplier, the rental car company, if they can have substantial substitution rights for that rental car, if they give you a Ford F-150 1 week and you have to return that car the following week for a Chevy Traverse, for example, you don't have a specific asset that you're obtaining all the economic benefit from, and you cannot control, you don't have the right to control the use of that specific asset. Or So in that scenario, even though it's a multi-year rental car agreement, you may not have a lease because you're not getting substantially all the economic benefit and you don't have the right to control that specific asset. So I'll turn it over to Chuck to talk about a few of the other terms. Before we do so, I think we're going to do a polling.
Yeah. Everybody ready for the first polling question? So you should see it on your screen. Has your business begun the ASC 842 lease implementation? Just a couple options for you. Yes, you're aware of it, but haven't done anything yet, or no. We're starting to get some answers in. It's trending towards we're aware of it, but not implemented yet. So give our last couple people a chance to vote. Again, if you're doing CPE, this is your time. Wake up, come back to the screen, do your polling questions. We generally have most people voted. I'm going to close it out in 3, 2, 1. And for you to kind of see where you line up, again, we got the majority of the people are aware of it, but have not done anything yet, Chuck. So do you want to take us on to the next piece?
Sounds good, Carolyn, thank you. Not surprising on the results, maybe a little surprising is that 21% have started. I'm not sure exactly what that might entail. Likely it's the accumulation of all your lease contracts, making sure you have all the latest versions, amendments, addendums, and starting to pull that population together and review what terms are actually contained therein. So, once you've started that process and you've pulled your population of leases together, remember, for financial reporting purposes, you likely have already done this for previous disclosures, but in some cases, it may take a little effort to pull together all the various amendments and addendums and things that just may have fallen by the wayside. But for ASC 842, really the starting point in those leases is figuring out exactly what the lease term is in each lease agreement. And for the most part, this is going to be contractual, easy to identify. The contract almost always will have a stated commencement date and a finish date, and generally that'll be something like 5 or 10 years, depending on the type of asset, maybe longer if it's office space. That's the easy part, so it's not hard to identify that period. But oftentimes leases will have a renewal option, and that renewal option, if it's at the option of the lessee, may or may not be included in the lease term. When you do include a renewal option in a lease term, you obviously have a longer term altogether. It's going to result in a greater or more substantial asset and liability on the books. So the tendency is going to be to ignore renewal options. But the FASB has said, if it is reasonably certain, defined as 75 or 80% probable or certain of being renewed, that renewal option needs to be included in the lease term. One of the things to consider is whether or not the lessee is economically incentivized to renew. For example, if the lessee has spent a significant amount of leasehold improvements on the space and the return on that investment cannot be achieved within the stated lease term, it's likely that the lessee, or reasonably certain, that the lessee will renew that lease. If there's no other viable options of office space or just whatever it is, you have to make an assessment of whether you're reasonably certain to renew. History will also be an interesting factor in making this decision. Are you often exercising renewal options in the past, and therefore, would you look to that now to help make this decision of whether you're likely to do so in the future, depending on the type of asset and whether it's unique or not. But bottom line is, if you have a lease term with a renewal option, you need to include the renewal option in the overall lease term, or the accumulated lease term, if you're reasonably certain of exercising it. And you'll see that this is extremely important determination. The only other thing I wanted to mention on this slide is that you are required to do a reassessment of the lease term only if there's a significant event or change in the business of the lessee, circumstances of the lessee, or if you've actually exercised an option that you previously had determined that you weren't going to do so, or it wasn't reasonably certain that you would do so. At the point in time that you do exercise that option, you have to reassess your lease term, both the current option that you're in and any future ones you think are reasonably certain to exercise, and basically reassess the accounting and make any changes that you'll need to from that point forward. Okay, on the next slide, just briefly want to mention a nice sort of policy election that everyone can make. If you have a lease term of less than 12 months, then you can make a policy election to treat it as a short-term lease and essentially ignore putting it on the balance sheet. You can call this a month-to-month lease, or you could call it operating, but that would be confusing. I would just say it's an off-balance sheet lease. Now, before everyone decides to change all their leases to 12 months or less to get out of the new accounting, if there's a renewal option in the lease, you still have to go through the same criteria that we talked about on the slide before. Is it reasonably certain that you'll exercise that renewal option? If it is, and you have to include the renewal option and it increases the lease beyond 12 months, then you don't have a short-term lease. So this is the stated term plus any renewal options you're likely to exercise. Entire term, if it's less than 12 months, you can keep it off balance sheet. Otherwise, you need to go through the remainder of the accounting that we're going to talk about. You know, I always have a caution here. I've quite a few companies say, well, we're just going to convert our leases to month or to 12 months because we don't feel like dealing with the accounting. And I get that, but the accounting really isn't that hard. And you know, there's help out there, and we'll talk about that. But don't let accounting wag the business tail. The business needs to lead. Don't make decisions to avoid accounting. A 12-month lease obviously could be quite detrimental depending on the circumstances. Could you put you in a position, especially in an inflationary environment, where the next 12 months are going to cost you a lot more? So, you know, I think it's better just to make the leases in the terms that make the most sense for your business, let the accounting fall as it may. But if you are in a month-to-month lease or less than 12 months, you do have a nice out from the FASB of excluding it from the balance sheet.
Yeah, Chuck, this is where you go back to principles-based accounting, right? The convergence to principles-based and IFRS. The standard setters and the audit firms are going to look more at the history of each company and what they've historically done and what they've consistently done with their leases, right? If all of a sudden an auditor sees everyone going to a 12-month lease or a month-to-month lease, there's probably going to be a discussion had, right, that we're going to want to look back at what have you done in the past, and we're likely going to want to treat it consistently.
Okay, thank you, Jeremy. So let's talk about the next steps. So we've got our population of leases, we've identified our lease term, we've considered renewal options. Now we have to identify our lease payments. And again, a portion of this for most leases is going to be quite easy. There's going to typically be a base rate or a stated rate per month, and you're basically just going to calculate the payments over the lease term you calculated in the previous slide using that stated rate. Now, from a fixed perspective, there also are other things that might be present in the lease that have to be considered lease payments. If there's a purchase price option and a stated exercise price to execute that option, and you think it's probable that you're going to make that exercise, that would need to be included in your lease payments. It would be I guess you could call it a balloon. It's not really a balloon, but a payment at the end of the lease to end the lease and purchase the asset. That would need to be considered. If there's any lease incentives, sometimes those are in the form of upfront cash payment to incentivize you to enter into the lease, or sometimes those are in the form of reimbursement of leasehold improvements. You know, the landlord may decide that your improvement of the space is beneficial for both parties, and they're willing to reimburse you for part of that, all of that, some of that. That's a lease incentive, and that would reduce your fixed lease payments if that were to be the situation. And if there's any leasehold improvements that you're required to make, I think about space that you might be leasing that needs significant repair work, electrical, plumbing, flooring, and the landlord may require that to meet the criteria of the insurer. If they require it, that's a fixed payment that needs to be considered in the lease. If you say, well, I don't know the amount, it's a reimbursement type situation, or the landlord's going to authorize it, most of that's going to happen before you actually commence the lease. You can't enter the space until it's insurable. So you would just account for that as a fixed payment included in your total lease payments that need to be made. So just pay attention to that, because that is somewhat common to see some form of allowance or some type of, well, in this case, a required leasehold improvement, especially for space that's being built out. Okay, so fixed really isn't too bad. That generally is the easy part. The hard part is variable lease payments. The FASB has done a really nice thing here. Essentially, they're going to allow you for any variable payments that you can't predict, or even if you can't predict, then you can exclude those from the lease. Like, let's start with the second and third bullet first. If you're in a retail type lease where your lease is based on a percentage of sales, the portion of the lease payments that are based on future sales are excluded from lease payments at the commencement date of the lease. So when and if you make any performance-based payments, such as a percentage of sales, you're essentially just going to charge those to the income statement as you make them. You're not going to account for them as a liability on the balance sheet. You're just going to basically expense them as they're incurred. So that's pretty nice. If you have a portion of your lease that's based on usage, miles driven, units produced, you remember the old copy machines that had tickers on them? I am old, I guess, but those situations, usage would also, you can't predict it. I mean, you might be able to estimate it, but you can't really predict it with certainty. Therefore, it's variable. Therefore, it's out of the initial lease liability, out of the initial lease payments. You account for it as you go. Pretty good. A lot of leases, however, have price changes due to some market rate or index. Those are also excluded unless it results in some type of specified and fixed increase to the base rate. So, for instance, if you have a contract that has a CPI increase, but it says that if any CPI increases after day one will be it will be added to your base rate. Well, you can't predict the CPI increase, and therefore you're not going to include that. That's variable. However, if the contract says that after year one your base rate will be increased by CPI, not focus on changes, but by CPI, you would look to the current CPI index in place at the date you entered into the lease, and you would predict your payment increases based on that CPI amount. But you would never account for any potential increases in that amount. That would be treated as a sort of as incurred basis. I find this particular bullet to be extremely confusing. I've read all the Big Four books, and I'm not sure any of them do a better job of explaining it. But I guess the best thing I could say here is that in order to be included in the lease, it has to be specified and fixed. If it's not, then it's excluded, treated as variable, and accounted for as you go. All right, just another thing I wanted to point out here is that if you have a variable lease payment that's in substance fixed or partially in substance fixed, that needs to be included in your fixed payments, included in the lease payments, included in the lease liability. So what does this mean? A lot of times, if you are in a performance-based lease, the most common being a percentage of sales, and yet there's a minimum that you have to pay no matter what, the minimum would be included in the lease payments because you can't get out of it. That portion is fixed in essence. Or, for instance, if the lease says, like in this example, it's on this slide, if rents increase by the greater of 1% of the lessee corp's generated sales, or 3% of the previous rental rate on the anniversary of the lease commencement date. Well, in this case, it's the greater of, and no matter what, it's going to be at least 3%. So you would account for the 3% rental increases over the term of the lease, and those would be included in lease payments and ultimately the lease liability. That's in essence fixed, or in substance fixed. All right, so I know I'm marching through quickly. Just please ask questions if you have them. So now we're going to turn to lease classification. So we're armed with our population of leases, we're armed with our lease terms, and we're armed with our lease payments. Now we can go through all of these criteria and figure out what kind of lease we actually have. As we're focusing on lessees, there's only going to be two choices: finance lease or operating lease. A finance lease is essentially equivalent to a capital lease under FAS 13 or ASC 840. A operating lease is the same as an operating lease. It always has been, with the exception that it's coming on balance sheet rather than just being a footnote disclosure. But those are the two types. I don't know why they didn't change the name of operating. I think it's just a little confusing because that's what we called it before, but that's what they chose to call it, whereas capital became finance. If you're a lessor, it's going to be slightly different. We'll talk about that on the next slide briefly, but I don't think we have too many lessors on the webinar, so we are focusing on lessee accounting. So deciding between a finance lease and an operating lease, the ramifications are not much different between the two. We'll talk about how it affects the P&L, but they're both coming on balance sheet, so it doesn't matter which one you have unless it's less than 12 months. So you're going to go through these 5 criteria for each of your leases, and you're going to determine whether or not you have a finance or an operating lease. The answer to any one of these 5 criteria, if it's yes, puts you in finance. Doesn't matter if all the rest are no. So answer to any one of the 5 puts you in a finance lease. I'm just going to focus on the new one first, and then I'll go back to number 1. Number 5 is brand new. So this consideration is that if you're leasing an asset that has absolutely no alternative use to the lessor other than the lease to you, then you essentially are using the lease over its entire useful life, and therefore you have a finance lease. Examples, I think of my experience with aerospace and defense. Oftentimes they may be leasing an asset that's built to order just for them. They may be using it in their manufacturing process. It's not going to serve anyone else. So no matter what the lease term is, they're essentially using it for its entire useful life. It's got no usefulness beyond that. And so in that case, you have a finance lease. That's probably not the case for most of us. So let's go back to criteria 1 through 4. Criteria 1, super easy. Just look for a transfership or ownership at the end of the lease term. You will not often see that, so that criteria is not often met. But if it is, then you're in a finance lease. Second option, you have an option to purchase the asset that's likely to be exercised. You remember those old options for $1 for $1? That's pretty likely to be exercised. So if you have that circumstance, I think you meet criteria number 2. Otherwise, you're going to look at the facts and circumstances and making the decision of whether it's likely that you're going to exercise it. I'd go back to reasonably certain, and that's defined as 75 to 80% certain that you're going to make that purchase at the end of the lease. That's called a bright line. Even though this is supposed to be much more practical and substance over form type accounting, the FASB is still going to allow some bright lines. And so number 3 is going to get a bright line too. If the lease term is for a major part of the remaining economic life of the underlying asset, then you have a finance lease. How's that defined? 75%. So if you're using 75% of the remaining economic life of the asset, you have a finance lease. So if we really want to apply bright line, which I suggest we do because I don't know a better way to do it, if you have a 10-year asset, it's got a 10-year life on it, and you're using 7 out of the 10 years, or that's your lease term, you have an operating lease. But if you're using 8 or 7.5, you have a finance lease. So there is a very good bright line there. Again, I don't know how common this will be unless you're leasing the asset towards the end of its useful life, or perhaps for a vehicle which may only have a useful life of 7 years or so. Number 4, present value of the sum of the lease payments and any residual value guaranteed by the lessee, if that's substantially all of the fair value of the asset, in this case, bright line is going to be 90%. So if that's the case, you have a finance lease, so you have to add up all your lease payments. You take the present value of that, and I'll mention the discount rate in a second, and Jeremy might talk about that briefly. You compare that to the fair value of the asset. If it's 90%, you've got a finance lease. And I can see the questions popping in. Well, how do I know what the fair value of the asset is? I didn't buy it. You didn't, but for the most part, you should be able to identify replacement cost or what it would have cost you to buy it. That's generally available. If it's not available because it's a unique asset, just ask the lessor to give you an idea what the fair value is. And if either of those two fail, you have the requirement to make a special effort to try to figure out the fair value using some other means. But keep in mind, if any of the other 5 criteria are met, don't worry about this one. You're already in finance lease accounting. You don't have to deal with this. So, or you can use a judgment call here too. I mean, you can apply some reasonable judgment. But this is probably the hardest one to apply. Now back to that present value. I'm going to make it really easy for all the private companies out there. You have a policy election that you can apply, and it's basically to choose to use the risk-free rate that's commensurate with the lease term. And you can go out there, let's say if a 5-year lease, you can go out the 5-year notes that are risk-free and use that rate at the date of commencement. That's no problem. You're allowed to do that. You can also choose, if you like, to use your incremental borrowing rate. I just got done speaking with a client who wants to have the lowest lease liability possible for their own purposes. And I guess a lot of people can relate to that. Their incremental borrowing rate's a lot higher than the risk-free rate. They want to use that. No problem. It's a policy election. You can choose which one to use. So that's kind of nice. And so, use the one that makes the most sense. For me, the risk-free rate is probably the easiest to identify and support. And so I would generally choose that. And I do think that even though the liability is coming on the books and we all want to keep it as low as possible, a lot of times the banks are just going to ignore it anyway. And the banks are most of your constituents or your users. In a few instances, we're talking about investors, and they may care a little bit more about that on balance sheet. So, depending on your facts and circumstances, having this liability on your balance sheet that the banks may just adjust out or may take it out of EBITDA, for instance, on the profit or loss calculation, mostly for operating. Talk about that too. It doesn't really matter. So use the easiest way to apply this guidance as possible and move on. So that's all I want to talk about the 5 criteria. Very, very briefly at the bottom, I'll just say that if you're a lessor, basically if you meet any of those 5 criteria exactly as stated, then you have a sales type lease. So the finance lease is a sales type lease for a lessor. Otherwise, it's an operating lease for a lessor. Or if there is any kind of third-party residual value guarantee, this isn't a lessee guarantee, it's a third party outside of the lease agreement. Well, it's part of the lease agreement, but they're a third party to the lease. If there's any kind of guarantee, you got to factor that in your lease payments when you apply criteria 4. And if that becomes a yes, then you have a direct financing lease. 3 classifications for lessors, only 2 for lessees.
So Chuck, real quick, I'll give you a breather for a second. I know there's a banker or two I saw that is online. Thanks for joining us. Just based on what we've seen thus far, bankers in the banks are either amending the terms of the agreements when there are debt service covenants. They're also some are also taking the position of allowing companies to opt into what they're calling quote unquote frozen gap. So what I would do is encourage all of you as soon as possible to get with your bank and see kind of where they're at with the terms, if they're modifying agreements, if they're allowing you the concept of frozen gap, right? So just so you know now what the year-end impact might be on any financial covenants that you have.
Okay, thank you, Jeremy. I'm just really briefly going to take you through the next slide or two. In this particular slide, I actually think this is a great one to kind of print out of the handouts or save down. This gives you the exact difference between a finance lease and an operating lease. And Jeremy's going to talk a little bit about EBITDA, if that happens to be a criteria that you're concerned about, and many of you are. So finance versus operating, they both come on the balance sheet. So assuming you got a more than a 12-month lease term and you're not applying the election to keep it off balance sheet, if you do, it's all coming on balance sheet. So it doesn't matter which one, they both come on with a right of use asset and a lease liability. The difference is on the income statement. A finance lease is going to apply the interest expense method, or the effective interest method, we should call it, to basically record interest expense over the term of the lease and to amortize down the lease liability. The asset, however, is amortized on a straight line basis. So this accounting will result in what I guess you could call volatility in your P&L. Essentially, what's going to happen is you're going to pay more interest expense up front and less at the end, whereas the asset's going to get straight line over the entire lease term. Overall impact on the P&L, higher in the beginning, less at the end. And for this finance lease, you're going to record interest expense, and your amortization of the asset's going to go to depreciation amortization expense. Both of these are excluded from EBITDA. So very interesting that you're not going to have any rent expense for a finance lease other than your variable lease payments as they occur. But the general accounting is going to result in everything being excluded from EBITDA, which is actually quite interesting, I think. Operating leases is entirely different. An operating lease, what you're going to do is continue to use the effective interest rate method to amortize your lease liability. But what you're going to do is amortize the asset as the differential between the effective interest rate method and getting to a straight line lease expense result. So the amortization of the asset is essentially a plug. And as you can tell, it's going to be lower in the beginning and higher at the end as lease expense goes from higher to lower. And ultimately, you're going to end up with the same answer as a finance lease, except all of this lease expense is actually classified as rent expense. All of it is actually in earnings and not excluded. It's all included in EBITDA, not excluded as interest and depreciation and amortization. So you will have quite a bit of a different EBITDA answer between the two of these. You'll have a timing difference between the two, but ultimately they'll all get to the same place from at least a net income standpoint. All right, briefly just going to touch on lessors. So we're going to skip 2 slides. There you go. All I'm going to say about lessors for the purpose of this presentation is out of the 3 types, sales type, remember if you meet any of the 5 criteria, you have a sales type lease. You de-recognize the leased asset, comes off your balance sheet. You're going to actually get to recognize the sale of that asset and the profit or loss at the lease commencement date. The only thing that's going to happen over the term of the lease is you're going to recognize the interest income, and you're going to use the effective rate of interest in making that determination of what that is. Direct financing, remember if you have a residual guarantee by a third party, you potentially have a direct financing lease. In this case, same accounting, except the selling profit or loss is deferred and recognized over the term of the lease. Operating lease, which most will be, if they don't meet any of those 5 criteria, stays on the lessor's balance sheet. The asset's depreciated over its useful life, and lease revenue is recorded on a gross basis over the term of the lease. So, you know, not very different than what's happening today, other than just some terminology differences here.
All right, that's a lot of good information. We're going to launch our next poll. So everybody, if you want to come back to your main screen here, and everybody that needs CPE, time for another poll. Question is, how does your business plan to handle the ASC 842 lease implementation? So your options are, you'll handle internally, you'll engage external specialists, you're not sure yet, and you need help. Your last option. So it looks like 53%, 50-some% are handling internally. A couple people not sure yet. A couple people got an external specialist. We'll give this poll just another minute or 2. A lot of people handling internally. All right, we're gonna close this out in 3, 2, 1. All right, so let's take a quick look.
All right, thank you, Carolyn. Before I hand it over to Jeremy, I just want to comment on this. Not surprised. I know a lot of our listeners are probably dealing with very few leases, and therefore the complexity is low. Jeremy and I are heading up the Troncony, I guess you can call it the SWAT team on leases. So we're here to answer questions as you have them. So feel to reach out. Not much different than how we handled the COVID relief programs here at Troncony. Which I recognize many names on our participant list as people we've helped. And so you know the drill, you definitely can reach out and help. We will answer questions. For those that want to engage an external specialist, Jeremy and I will be performing this on behalf of anyone that needs it. So, all we'll need is the population of your leases and we can help you from there. Working lockstep with management along the way to make sure that we're coming to the correct answer. So, you can reach out to us for help here. We're definitely willing and available to help each and everyone that needs it. We've already done this for quite a few public companies, and so we're ready to continue helping the privates. Jeremy, I'll turn it over to you.
Thanks, Jeff. All right. Now we're quickly coming to an end of our time here. So in order for us to get through the rest of our disclosure requirements, as well as answer your questions, I'm going to go through the next few slides pretty quickly, but I'm happy to answer any questions that you may have afterwards. So please feel free. You can reach out, you can email me, call me, whatever you need. But now that we've looked at the lease terms, lease payments, and lease classification, now's the fun time to record and make the accounting entries. So recording the right of use asset and lease liability at the lease commencement date, you always want to start with your lease liability, and that is based on the present value of the remaining future lease payments over the lease term. That includes all fixed and qualified variable lease payments. Those are lease payments that essentially are known. Chuck went through those. Those are netted against future lease incentives, plus any exercise price of an option to purchase the underlying asset if the purchase is reasonably certain and the amounts are probable of being owed by the lessee under any residual value guarantee. So now that we have our lease liability, I recommend, in order to calculate it, the present value, Excel has some good formulas you can set up. We also have amortization of software. If you need help with any of that, please let us know. Now that you calculated your lease liability, you can then start calculating your right of use asset. So your right of use asset is always starting with your lease liability that you've calculated, adding in any initial direct costs. Those are costs incurred to enter into the lease agreement, so commissions to agents, legal fees to execute the lease, or payments to third parties for guaranteeing the residual value. Add in any prepayments of lease payments that qualify as lease payments. Reduce any accrued rent that you have yet to pay, and then reduce off any lease incentives that you've already received as well. So just going into a quick example, assume an entity has a lease for office space for 5 years with annual payments of $100,000. Now, this next piece is really important. These payments are payable at the beginning of the year. So in this example, just pay attention. It's beginning of the year that the $100,000 is paid. Again, if for your specific scenario, you can change it, the year to months, quarters, whatever you need to do for recording purposes. The interest rate in the lease is not readily determinable, so the entity uses its incremental borrowing rate, which is 8%. Chuck also alluded to the fact that you could also use a published risk-free rate. That risk-free rate must be on the same term and commensurate with your lease term as well. So the entity makes the initial payment of $100,000 at the beginning of the year, and then records the lease liability of $331,000. The lease liability, again, is calculated the present value of the 4 remaining payments that you have to make at $100,000. So the entity will then record a corresponding right of use asset of $431,000, which is the lease liability $331 plus the $100,000 that you've already paid. So your initial entries are debit right of use asset for $431,000, credit your lease liability for $331,000, and then credit cash for $100,000 based on the initial payment. So go to the next slide. Let's throw a wrinkle or two in there, and I'll go through this one pretty quick. The entries are essentially the same, but now the lessor provides a lease incentive of $35,000, and the lessee also has to pay a broker to locate the property. They pay them a commission of $10,000. So with that, those set of facts, the right of use asset now would be $431,000, less $35,000 lease incentive, plus the $10,000 initial direct costs. So your right of use asset in this scenario is $406,000. So let's continue the analysis to reflect the accounting as the property is used. At inception, the opening entry, again, debit right of use asset in this scenario, credit the cash, and credit the lease liability. In this scenario, the lease was categorized as an operating lease, and the entity has determined its total fixed rent is $475,000. I've added the calculation there. Therefore, on an annual basis, it will recognize $95,000 of rent expense. So just going back to reflect real quick, under operating leases, under the new standard, fixed rent is always straight line over the lease term, rent expense in the P&L, and that's the same type of treatment under current GAAP. Whereas on a finance lease, rent is based on the effective interest method. And again, it's very similar to debt under current GAAP. So just a couple things to think about there. All right, so now what we need to do is we need to, at the end of each year, we need to true up the liability and record rent expense. So for us to do so, we need to accrete the interest at 8%. Chuck mentioned the effective interest method. So what we'll do is we'll recognize rent at $95,000. The lease liability will be increased in this scenario to accrue for the interest over the period. So we'll record $26,000, which again is our initial lease liability at 8% for the period. And then our offset is our right of use asset, the amortization, which is our $95,000 of rent expense less the interest portion. So in this scenario, I hate to say it in the accounting world, but for an operating lease, your right of use asset amortization is essentially the plug, right? It's the difference between your rent expense and your accretion of the interest for the year. So at the end of the year one balance, your right of use asset is now $337,000, and your lease liability is $357,000. Flipping to the following year, beginning of year two, you now make that second $100,000 payment. So that's when you reduce your lease liability by $100,000 and credit your cash. The next slide, okay, you're good there. All right. So I'm not going to go through the whole example again, but again, if this were a finance lease, the biggest difference is the right of use asset is amortized on a straight line basis. Again, same way it is under current GAAP accounting, and the interest expense would be accreted the same way, and therefore rent expense is higher in the beginning of the lease and declines as the lease liability declines. Same treatment in current GAAP for balance sheet purpose. Again, I'm not going to go through the next couple slides. Chuck went through them in pretty good detail. We just wanted to provide these as additional summary of the impact on the balance sheet. Chuck mentioned on the income statement slide the impact for EBITDA. So under current GAAP, right, EBITDA is typically lower for an operating lease versus a finance lease. That'll be the same scenario under new GAAP accounting. Cash flow impact, again, the same treatment. Cash flow, the cash flows will not change under the new standard. For operating lease, your entire payment is within operating, whereas in the finance lease, your interest is in operating, and your principal payments are disclosed in your financing section of the cash flow. We're doing another polling question?
Yeah, great. Thanks, Chuck. Sorry, thanks, Jeremy. We have our third poll for anybody that needs CPE. Our next question is, do you anticipating purchasing software to assist with ASC 842 lease implementation and ongoing accounting? So a couple choices here. You've already purchased identified software. You're going to utilize Excel. You're not sure yet, and you need help. See which one suits you the most. Looks like most people are looking at using Excel. A couple of people not sure yet. I'm going to give this another minute or two. I don't think you guys are surprised with the Excel answer. But you guys get the last, couple people have purchased software now, but a couple more votes in here and we'll close it out. Again, if you need CPE, make sure you get your full questions in. All right, and I'm going to close it out in 3, 2, 1. And share the results just real quick.
Yeah, based on what projects we've completed thus far, we are seeing, most entities, with leases fewer than 20 leases are typically using Excel. It's working just fine for them, or using our templates that we've set up. And companies that are generally have 20 or more leases are using a software. Again, those software are very sophisticated, and it makes sense for them. It helps with the entries. It kind of automates the process. But either way, Excel or software is fine. But if you need any assistance, again, please let us know.
Okay, great, thank you.
All right, thank you, Jeremy. I realize we're running a little short on time, so I'm going to focus on the most important aspects of the following slides. They're here in the handouts. You can peruse them. There's more information than we'll be able to cover, but I'll just give you the most important. So, and I know there's a question too, and we'll get to that as well. Okay, briefly, there's only one method of adoption at this point for ASC 842 for the private companies, and that's the modified retrospective approach. That's a sort of a convoluted way of saying that all you're going to do is adopt it, speaking to our calendar year companies, January 1st, 2022, and you're going to make an adjustment to beginning or opening retained earnings if you need to, but you're not going to do any restatement or recasting or anything else to the prior financial statements. You're simply going to put enough information in the footnotes that a knowledgeable user can get back to an apples to apples comparison. So what exactly happens with beginning retained earnings? The only circumstance I can think of at the moment is if you have anything on your balance sheet for leases, for straight lining leases. In most cases, it's going to be an asset. Some cases, it's going to be a liability. Whatever direction it goes, you're going to adjust that off the balance sheet, start with a clean slate, and push that through retained earnings. It just evaporates the retained earnings, no P&L effect, and you start with a nice clean slate. Pretty easy. If you're saying, well, what about my leasehold improvements? Ignore them. Just keep doing what you're doing. So, just keep amortizing those down. There's no impact on how you account for leasehold improvements. The only things we talked about was if there was a landlord allowance or something to that effect in the future. But the way you've accounted for those historically is the way you're going to continue to account for those. No issue there. So the only balance sheet thing I can think of at the moment that goes through retained earnings is the straight lining of rent. Maybe there's something I'm not thinking of, but that's all I've got at the moment. Now let's talk about practical expedience. So this is the most important slide. And so I would suggest that there's probably no one listening that's not going to adopt package number 1. Package 2 is irrelevant. Package 3 is probably not relevant. So let's just focus on package 1. It's referred to as a package because you have to do all 3 at the same time. You can't choose one and not the other. But there's really no reason I can think of that you wouldn't want to do this anyway. So this is really, really nice. Jeremy talked about embedded leases. A lot of our hosting arrangements or cloud computing or other types of arrangements might have some type of dedicated server in them. But to the extent that you've made a decision previously that that's not a lease, you don't have to reassess that under ASC 842. You only have to reassess that in the event that you enter into a renewal for that particular lease, a new lease, or some other significant modification. Otherwise, just continue with the current accounting, which is likely just charging it to the P&L as you go or as it's incurred and not putting anything on the balance sheet. In the future, you would have to potentially look at the lease component and separate that out. But there is another exception that I'll talk about on another slide. Number two, to the extent you've already gone through your current population of leases that exist at the date of adoption or have expired prior to that, you don't have to reassess them. If they're capital lease, they become a finance lease. If they're operating lease, they stay operating. You don't have to do a reassessment. Nice and easy. Keeps things simple, and you only have to do that prospectively for any amendments, renewals, or new leases. And then the last one is initial direct costs. We didn't spend much time talking about that. There's likely no impact here, but under the new guidance, initial direct costs are really only commissions for the most part. You can include those as part of your right to use asset and can essentially capitalize them. That's about the only thing you can capitalize. Legal fees, travel costs, anything else, accounting fees, you can't capitalize. But whatever you've done historically, you don't have to reassess it. Just do it for new leases going forward or any amendments or modifications. So really nice shortcuts there. I mean, it's not going to get you out of applying the lease accounting. It's just going to make it a lot easier for your initial adoption of the new standard. Very, very briefly, next slide. This is another policy election you can make as a private entity. You can elect to combine all your lease and non-lease components together and count for them as a lease payment. So back to that embedded lease situation, if you do have a hosting agreement with a dedicated server, you can treat the whole thing as a lease, assuming that it actually meets the definition of a lease to begin with, that dedicated server piece. And Jeremy took us through that. It's complicated, I know, but all it means is, do you control the asset or not? Is it got your name on it and no one else's or not? So just something to consider there. And then finally, all I'm going to do here is I'm just going to point you to a great public company who's made some excellent disclosures. And I'm just going to say, why don't we all look to that one as a good standard. There's plenty of other great standards out there. It just happens to be a company I chose to look at. They did a great job of disclosing their policy elections and also the other required disclosures. It's in your handouts. I'm just gonna flip through it here, and then we're gonna close the session after I answer a question. But so Carolyn, can you just flip a couple slides? So this is Cancellation Brands. Pulled this out of their most recent 10K. The year ended February isn't available yet, but this is last year's. In their accounting policies, they disclosed all their policies for leases, which I thought they did a nice job of, including their election with respect to leases that have a term of 12 months or less. On the next slide, in the footnotes, they basically broke down what's on the balance sheet, what's in the P&L. On the next slide, they broke down what's on the lease maturities, like they always have, and then what's in the cash flow statement and weighted averages of remaining lease term and discount rate. The majority of all this is required for private companies as well. And so, it's really nice that our public companies have given us some great examples to look to as we build our disclosures for private entities. Like I said, the majority of this is required and highly suggested. That way, the banks will have plenty of information to kind of peel things out if they choose to.
And again, this is in the handouts for anybody and in the presentation. We know it's fine print looking on your screen, so.
Great, and of course it's available on sec.gov for anyone that wants to do their own research. All right, finally I'm going to answer a couple questions that came into the chat, and then we're going to end the session. So real quick, Mike asked, does the new lease standard apply to intercompany related party leases? So there's two words there, intercompany and related party. If it's intercompany and it's eliminated in consolidation, ignore it. It's not a lease, you can basically ignore that. If it's not eliminated in consolidation, yes, it does apply. And if you don't have a lease agreement with your related party because you guys are doing things on the back of an envelope, now's the time. You're gonna need that. So get lease agreements in place. You're supposed to have them for tax purposes anyway, not to preach. So get that done. Yes, it applies, but don't worry about it if it eliminates the consolidation. You want to take the next one? Or...
Yes, okay, the next question is what if the impact of the new lease standard is material? Can you just footnote this in the financial statements? So essentially anything, yes. If it's not material, right, we could take a position that, you know, whether or not we dispose it or not, right, also depends on materiality. But yeah, if it's not material, if you have a lease copier, right, you know, small payments, a couple $100 a month, right, even though it may qualify as a lease, you know, you could take the position it's not material. Again, if we're your audit firm, we'll obviously want to look at our assessment of materiality. If we're not, then we'll obviously defer to your auditor.
Great, thank you guys. That was a lot of good information. If anybody has any remaining questions, I know it's right at 1 o'clock. Feel free to put them in the question box. We do have everybody's full contact information on the screen, in the presentation, in the bios, in the handouts. If you want to reach out to Chuck or Jeremy directly, feel free to do that there. I think we have one final poll for those people that need CPE. Just a quick poll for you. How was the webinar helpful today? Yes, I already knew this information. Yes, it was helpful, kind of helpful. I'm now more confused. And who forgot their lunch and is still hungry out there? Definitely at least have a couple people still hungry. A lot of people did find this helpful. I'm gonna wait for a couple more votes to come in. And I'm gonna close it out in 3, 2, 1. All right, I'll just share it real quick so everybody can kind of see where they're at. You know, we're definitely here for you. I will be emailing out this afternoon a copy of the presentation again, some more information. I will send you a link to the recorded version that you can pick up and listen to again, and or share with somebody that you think this would be helpful for. Again, our webinar survey will be coming to you once you close this out. Definitely give us your feedback. Let us know if you'd like to talk further with Chuck or Jeremy. And again, if you're looking for CPE today. Next month's topics will be sales tax for manufacturers in New York State. And I don't see any other questions, so we're going to wrap it up today. Thank you everybody for joining us and have a great afternoon.